So I will be very happy if we can solve like 3 questions today. So that means in our next class, we had additional 2 illustrations to making 6. But let's see how today's class we end. All right. Last week we solved, after the explanation of the methods of valuation, we solved a question uh, under which we are required to determine the value of Wazobia Limited using price earning ratio method. We also calculate the value of Wazobia using the liquidation or breakup basis, including replacement value basis, and then discounted dividend model. Okay. So, and today we are going to look at another illustrations. All right. Let's see. Let's see which question we are going to solve. Different scenario. Let me see. Quantum, not quantum yet. Yeah. Let me see this. Okay. Now let's solve this one that has the cost of capital. Let's see. Let's solve illustration number 7 for a start. All these big questions usually take time in the class, so you have to explain. Okay. 2 people are the one disrupting my class, Zoom user and then Emmanuel. Yes, Emmanuel, you have disappeared. You are the one that will read the question. Yes. Emmanuel, read. That's a compensation for making noise in my class. Yeah.
No problem, sir.
Emma? Okay, go ahead.
Vico Tony VT is a software design company established 6 years ago. The company is owned by 5 directors. Since establishment, the company has developed rapidly. VT finds it difficult to obtain bank finance and relies on long-term strategy of using internally generated funds to finance expansion. The directors are therefore giving consideration to the possibility of floating the company on the stock exchange market. As a first step, you have been appointed by the directors to advise on the current value of the business under their ownership. The company's most recent statement of profit or loss and the extracted balances from the latest statement of financial position are as follows. All figures in millions, sales 10,000. Okay. So we also have statement of financial position. During the current year, 1. Depreciation is charged at 10% per annum on the year-end non-current assets balance before accumulated depreciation and is included in other operating costs in the statement of profit or loss. 2. The investment in net working capital is expected to increase in line with the growth in gross profit. 3. Other operating costs consisted of the variable component at 15% of sales, 1,500, fixed cost 2,000, depreciation on non-current assets 254. 4. Sales and variable costs are projected to grow at 9% per annum, and fixed costs are projected to grow at 6% per annum. The company pays interest on its outstanding loan of 7.5% per annum and incurs tax on its profit at 30%, payable in the following year. The company does not currently pay dividend. One of your first tasks is to prepare for the director a forward cash flow projection for 3 years and to value the firm on the basis of its expected free cash flow to equity. In discussion with them, you note the following. The company will not dispose of any of its non-current assets, but will increase its investment in new non-current assets by 20% per annum. The company's depreciation policy matches the currently available tax allowable depreciation. This straight line write-off policy is not likely to change. The directors will not take a dividend for the next 3 years, but will then review the position taking into account the company's sustainable cash flow at the time. The level of loan will be maintained at 1.98 billion naira and interest rates are not expected to change. For estimating the appropriate required return on equity, it is decided to make use of the capital asset pricing model. The challenge, however, is that since company is not quoted, an appropriate beta factor does not exist. You have found a listed company, Computer Limited, that is into software development. KL is also into hardware retailing. It has the following financial statistics: equity beta 1.4, debt beta 0.2, debt equity ratio 40%, effective tax rate 25%. About 60% of the market value of KL is attributed to software development division, while 40% of the value is attributed to computer hardware retailing. The computer hardware retailing division has equity beta of 0.8. Risk-free rate is 4% and the market risk premium is 8%. And VT has maintained a long-term debt plus equity ratio of 20%. Required: provide an estimate of the appropriate rate of return to be used for the valuation of VT. Round your answer to the nearest whole number. B. Prepare a 3-year cash flow forecast for the business on the basis described above, highlighting the free cash flow to equity in each year. C. Estimate the value of the business based on the expected free cash flow to equity and the terminal value based on the sustainable growth rate of 4% per annum thereafter. Note: irrespective of your answer in A, assume required return of 17%. D. Advise the directors on the assumptions and the uncertainties within your valuation.
All right. Thank you very much, Ima. Yes, that is the question. Number A requirement. Number A requirement says it should provide an estimate of the appropriate rate of return to be used for the valuation of VT. Your answer should be rounded to whole number. All right, to the nearest whole number. So, examiner is asking you to calculate appropriate rate of return. You have to be very careful, right? When you talk about rate of return simply means cost of equity, right? It's just cost of equity because there's difference between rate of return and then cost of capital, right? When you are asked to calculate cost of capital, it means that you are supposed to calculate weighted average cost of capital, which will include both cost of equity and cost of debt. But in a situation whereby a company is only financed with equity, there is no debt, only equity, 100%. In that case, cost of equity and weighted average cost of capital will be the same. So in this question, you have to calculate appropriate rate of return. And that means you want to calculate cost of equity, right? Even in the question, examiner has told you that there's a place I indicated, yes. You are told that in the last bullet point, you are told that for estimating the appropriate required rate of return on equity, it is decided to make use of capital asset pricing model. You know, calculating cost of equity, you have 3 different methods that you can use. You can either use dividend valuation model, which of course in this question, that information to calculate dividend valuation is not complete, it's not here. Because for you to be able to calculate cost of equity using dividend valuation model, you'll be given information on dividend, you'll also be given information on the share price. All right. But in this question, the examiner wants you to use capping. All right. So if that is the case, without wasting more time, let's quickly go ahead and compute the required rate of return. So you can open to the material at your end while I switch to the working note so that within the next few minutes, we are done with this, and then we'll move to another illustration. Okay. This is solution to illustration number 7. All right. Solution to illustration 7. That's page 86. 86. Let me check from the beginning. Page 85. That's page 85 to 87. All right. Page 85. So the name of the company is Vicotoni Limited. So the first requirement is to calculate required rate of return. So number A, calculating rate of return. Using capping. All right. To calculate capping, you know the formula already, which is cost of equity, KE, equal to risk-free rate of return plus beta into market return minus risk-free rate of return. All right. So this is the formula for calculating capital Z price, cost of equity using capital Z pricing model. So in the question, we have been given the risk-free rate of return. Let's go back to the question. Risk-free rate of return. Let's see, where do we have information on risk-free? How much is risk-free rate of return? If you can find it before me, give it to me. Okay, yeah, in the second to the last bullet point, risk-free rate of return is 4%, and then the market risk premium is 8%. Okay, therefore, cost of equity equal to 4 plus. Now, in this question, you can see we are not given beta. We are not given beta value. That means you need to estimate the beta value. And that's what the examiner mentioned to you in the question. That, let me go back to where we have that information. There's a place examiner mentioned that the appropriate beta is not available. Which information is that? What page?
That is 2 bullet points before the risk-free rate.
Oh, okay. I want to read it out before the. Yeah, so you are told that the challenge for estimating the appropriate required return on equity, it is decided to make use of capital asset pricing model. The challenge, however, is that since the company is not quoted, an appropriate beta factor does not exist. Okay, so you have found a listed company, Computer Limited, that is into software development. KL is also into hardware retailing, and it has the following financial statistics. So the challenge then is that we are not given, for us to be able to compute required rate of return on equity, we need beta. To use capping, we need beta, and the beta is not given. So we have now been given the beta of a comparable company, which is Computer Limited. The equity beta of Computer Limited is 1.4, according to the question. Now, you have to shine your eye. You have to shine your eye. if you look at this question, this rate of return that we want to calculate, we have done similar thing under capital budgeting. If you remember the question that we solved, Telemundo PLC, the question we solved on capital budgeting, Telemundo, right? Is that question, I mean, this particular area, this particular requirement was carved out of that question, all right? So you are told that Computer Limited is into software development and hardware retailing, which means that Computer Limited uh, has two different activities, that is software business and also hardware retailing. So that means there are two different activities. So it means this beta of 1.4 is a combined equity beta. The 1.4 is meant for software development and then computer uh, retailing. So we cannot use this 1.4, beta of 1.4 as the beta of software, because what we want to calculate, we need the beta of software. That's what we want to calculate for, because this company is into software development. That is, Vicotoni is into software, and then you need the beta of software. So beta of software is not given in the question. You are given beta of software and hardware retailing. Therefore, you need to find a way. You are going to use the known variable to get the unknown variable. So once you are able to get the beta of software, then you can proceed. The next thing you are going to do is to ungear the beta. If it is geared, then you calculate, you re-gear the beta, then you calculate the cost of equity using capping. That's all you need to do. Those are the four steps you are going to do. The same step that you are going to do whenever you are calculating project specific, all right? It's the same thing, but the only thing is just that instead of you are not going to calculate WACC. All you need to do is to identify the proxy beta. You ungear the beta if it is geared, you re-geared, and you calculate cost of equity. That's all. So let's move on. Okay. Let's see. Let's say this one will end on this page. Calculating cost of equity. Let's say this one will end up to this point. Then uh, notes. Okay. The beta, the beta, the proxy beta, the proxy beta of software is not given. Is not given. Or the beta of software. Let me put it that way. The beta of software is not given. Therefore, the information, the proxy information given in the question will be used to estimate the beta of cement. Sorry, the beta of you can see I'm still recalling that same question. Now you remember that same question we did under Telemundo. You know, it has to do with we are looking for beta of cement that time. That's what that just crossed my mind. That come to my mouth now. Instead of beta of software, to estimate beta of software. This is shown as follows. Okay. All right. So now you will recall that, like I explained earlier, Computer Limited is into two different activities. Computer Limited is into software development and hardware retailing. And we have been given the beta of equity beta. That's a combined equity beta. We are also given beta of hardware retailing to be 0.8. Therefore, in the procedures for calculating work of the combined activity, step one is to identify the beta of each activity, right? Then step two, you ungear the beta if it is geared. Step three, you calculate market value of equity and debt of each activity. Then step four, you calculate weighted average of the combined, weighted average asset beta or beta asset of the combined. So that same formula that we normally use to calculate weighted average asset beta is the formula we are going to use to determine the beta of software. All right. Therefore, I will then come here, combine equity beta equal to beta equity of software, okay? Beta equity of software multiplied by total market value of equity and debt of software divided by total market value of equity and debt of software and hardware on one side plus beta equity of hardware multiplied by total market value of equity and debt of hardware over total market value of equity and debt of software and hardware. I believe you remember this formula. All right. So now that we have the formula, the combined equity beta we are given as 1.40 equal. We are looking for beta equity of software. We don't know it. Then multiply by, I will then go to the question. According to the question, what is the market value? What is the market value of cement? You are told in the question that about 60% of the market value of KL is attributed to software development division, while 40% of the value is attributed to computer hardware retailing. So software is 60%, 0.60, okay? Plus, there's no need for you to say 60 over 100 again, since it's 60%, just use it directly. Then beta equity of hardware. According to the question, you are told that the beta equity of hardware is 0.8. The computer hardware retailing division has equity beta of 0.8. So here will be 0.8 multiplied by the total market value of equity and debt of hardware is 40%, 0.40. Therefore, 1.4 will be equal to 0.60 BES plus 0.32. Okay. So the next thing we need to do is to collect like terms. So in this case, I will then say 0.60 BES equal to 1.40 minus 0.32. Therefore, beta equity of cement will then be equal to 1.4 minus 0.32. That should give us 1.08, I think. 1.08. Is it 1.08? Please confirm.
Confirm.
Yes, sir.
All right then. So divided by 0.60. So this should give us, I don't know, 1 point what?
8. 1.8.
Okay. So 1.80 is the equity beta of software. So this is what examiner has hidden in the question. They ask you to go and look out for. All right, now that we have the beta to be 1.8, the next thing we need, you cannot use this beta. This beta of 1.8 belongs to Computer Limited. So you then need to calculate the beta of what's the name of the other company? Vicotoni. We need to calculate beta of Vicotoni. Now that you have found the beta of Computer Limited, so you need to ungear this. Now, this beta, is it geared or ungeared? So you need to go back to the question and check whether the beta is geared. The beta will be geared if Computer Limited has debt in its capital structure. So according to the question, we are given debt equity ratio of 40% for Computer Limited, which means that this equity beta is geared. So since it is geared, we need to ungear it. So step 2 now is to ungear. Now, to ungear, we need to check from the question whether debt beta is given or debt beta is assumed to be risk-free. So according to the question, we are given debt beta of 0.4. All right, 0.2. We are given debt beta of 0.2 for Computer Limited. It means that we are going to use the extended formula. Therefore, beta assets to ungear, we are supposed to calculate beta asset. Therefore, beta asset is equal to beta equity of a gear multiplied by, all right, equity value over equity plus debt multiplied by 1 minus tax rate of the proxy company plus debt beta multiplied by debt value multiplied by 1 minus tax all over equity value plus debt value 1 minus tax. So this is the formula. You're already familiar with this. All right. So let's put in the figures. So the beta asset that we want to calculate is equal to the beta equity of a gear that we have found is 1.80. So I need equity value of Computer Limited. I will then go back to the question, what is the equity value of Computer Limited? So according to the question, equity value of Computer Limited, the debt equity ratio is 40%. Debt equity ratio of Computer Limited is 40%. So if debt is 40%, equity will be 60%. But according to the question, examiner told you that VT has maintained a long-term debt over debt plus equity. What this simply means is that examiner wants you to use total value to calculate your gearing ratio. Examiner wants you to use total value to calculate your gearing. I told you when I was explaining the concept under project-specific cost of capital, I mentioned to you that if the gearing ratio has been defined by the examiner, you have to follow the instruction. Ordinarily, if debt is, according to this question, if debt is 40%, okay, if debt is equal to 40%, equity is supposed to be equal to 60%. But because of the fact that examiner has defined the gearing ratio for you, that the gearing ratio should be long-term debt over debt plus equity, that is D over D plus E. This is the total value. Examiner wants you to use total value for the gearing ratio. So what this simply means is that D will be equal to 40, then equity will be equal to 40 plus 60. That's the implication. So in this case now, in our own calculation, E will be equal to 100, D will be equal to 40. That's the instruction the examiner has given to you. Therefore, I will then come here, E is 100 over 100 plus 40 into, then the tax rate of Computer Limited is 25%. You have to be very careful. In this question, examiner has given you two different tax rates. 25% for Computer Limited, which is the proxy company, then 30% for Vicotoni Limited. All right. So don't go and assume that the two companies will have the same tax rate. You have to shine your eye. So if 25% is the tax rate for the proxy company, that means we're supposed to account for 75%. So 0.75 plus the other side. The debt beta given to us in the question is 0.2. Okay. Debt value is 40 into 0.75, 1 minus tax, divided by 100 plus 40 into 0.75. Okay. So give me from the left. What do you have? 100 divided by 130 multiplied by 1.8. What do you have? Okay. Multiplied by 1.8. It's like you are not ready for me. That's 1.38. Here is 1.38 plus the right side. On the right side, 30 over 130. 30 divided by, excuse me, 30 divided by 130. Okay,
0.23.
multiply 0 point
Oh,
what?
sorry. No, sorry, I
0
don't know
point
what.
0, 0 point,
0.046.
all right.
Okay, fine.
So here will be equal to 1.43. So the beta assets, the ungear beta or beta assets is equal to 1.43. Step 3 says we should regear. We want to calculate capping. So step 3 says we should regear. So I would then say regear to incorporate the financial risk of Vicotoni. Vicotoni is the main company. All right. So before I write down my formula, I need to check from the question. I want to regear. That is, I want to calculate vital equity of a gear company. So I need to go back to the question. For Vicotoni, am I given debt beta or debt beta is not given? In this question, the examiner does not give us debt beta of Vicotoni. It means that debt beta is assumed to be risk-free. So if that is the case, I would then say beta equity of a gear equal to beta assets multiplied by 1 plus 1 minus tax, debt equity proportion of Vicotoni. Vicotoni is the main company. So this is the formula we are going to, if debt beta is given to you, you repeat the same formula we use for beta assets, this same bit for nothing formula. This is the same formula we are going to use if you are given debt beta for the main company. But since you are not given, then this is the formula, this is the appropriate formula to use to calculate beta equity of a gear. All right. So then the beta equity of a gear equal to 1.43 multiplied by 1 plus the tax rates. The tax rate of Vicotoni is 30%, which is 0. We are supposed to account for 0.7. Then the debt equity proportion of Vicotoni is 20%. So here will be 20 divided by 80. I mean, debt is 20, then equity is 80. When we are calculating our WACC, then of course, in this case, we are not calculating any WACC, so just a reference. So I would then say 20 over 80, 20 divided by 80. Oh, sorry, it's an error. 20 divided by, what's wrong? 20 divided by 80 equal, then multiply by 0.7 equal plus 1 equal, then multiply by 1.43. That's 1.68. 1.68. So finally, we calculate capping. The capping is what we wanted to calculate before. We are doing it before we stopped it, so we can then go back. Or, okay, yeah. Let's just use the 1.68. 1.68 is our beta. So this beta of 1.68 include both with incorporated debt and equity. With incorporated is a gear beta. So because again, Vicotoni has debt in its capital structure. So the 1.68 must be consistent with that. And we have incorporated that. So in this case, the examiner has given us the risk premium. We are given a risk premium of 8%. So here will be equal to 8. The difference between market return and the risk-free rate of return is called risk premium. An examiner has given to us the risk premium to be 8%. So don't need for you to be doing 8 minus 4. When you do 8 minus 4, that means you are saying that this risk premium is the same thing as market return. So be careful. So final answer here of
17.
17 point what?
44.
0.44%. So examiner said we should round our number to the nearest whole number. So here will be 17%, approximately 17%. So I would then say the cost of equity, the required rate of return on equity for Vicotoni is approximately 17%. Okay, it's approximately 17%. All right, so that is that. So with this, we have pocketed 7 marks. You can imagine. Bonus 7 marks out of 100%. We are looking for 93%. Let's go elsewhere and look for that. All right. So the second requirement says you should prepare a 3-year cash flow forecast for the business on the basis described above, highlighting the free cash flow to equity in each year. So we want to calculate free cash flow to equity. How do you do this, right? How do you do this? So let's go back to the question. Let's go back to the question. First thing first, let me establish my table. Let me design my table. Number B, you want to calculate free cash flow, calculating free cash flow to equity. Remember, free cash flow to equity is the cash flow available for distribution to equity holders or shareholders. All right. So to do this, I gave you 3 different formulas that you can use to calculate free cash flow to equity. In this particular question, because examiner has told us that there will be growth in sales value, all right? So we need to make adjustments. We need to make some adjustments. Let's go back to the question together, all right? We want to calculate free cash flow to equity. What are you supposed to do? When you look at the income statement given to us, we can see in that income statement, you can see operating profits of 246 million naira. Operating profit of 246 million naira. Ordinarily, if not because we have adjustments to make, we would have just picked the 246 million. You start from operating profit before interest and tax. You adjust for interest, you adjust for tax, you consider non-cash item, changes in working capital, capital expenditure, loan repayment, proceeds from debt issues. So if you have all of that. But in this question, because we have adjustments, because examiner has told us that sales and variable costs will increase by 9%. Fixed expenses will also increase by by 6%. So in this case, we need to go and make our adjustments. We can't just use this 246. It's not useful for us. Therefore, I will then go ahead and design my table. It's for 3 years. The free cash flow to equity we want to calculate is meant for 3 years. Therefore, I will say year one. Let me see. That's too close. Year one, year two, year three, if possible, you create additional column for workings. You have to shine your eye. You have to shine your eye. You must establish, you have to articulate your points. Find a way to maximize your points. So, in the income statements, we also have, see, instead of you to be doing it one by one, you need to strategize, find a way you can follow a kind of a shortcut that will not impair your mark, that will not make you to lose valuable marks. So instead of me to, cost of sales, variable cost is also embedded in cost of sales, right? Instead of me to increase sales value by 9%, I will also increase cost of sales by 9%. That's a waste of time. Remember, variable cost and gross profit and contribution are almost the same thing, because when you are using marginal costing method, the difference between sales and variable cost represent contribution. But if you are using absorption costing method, the difference between sales and cost of production will give you a gross profit. So this is profit or loss account. Therefore, we are going to pick the gross profit of 4 million. That's where we are going to start from. This 4 million is the current value times. So you have been given the current value information. So in this case, you are supposed to inflate the 4 million by 9%. So I would then say gross profits. We are starting from gross profit. If you start from sales value, it's still the same thing, but it's a waste of time. Here is 4,000. Figures are in million. Okay, let me even indicate naira. So here is million, 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 then gross profits, which is 4,000 at inflation rate of 9%. Okay, therefore 1.09, 1.09, 09, what's wrong? 1.09 multiplied by 4,000. That's 4,360. 4,360. Whatever you have in your calculator, multiply by 1.09. That's 4,752. What you have in your calculator, multiply by 1.09. That's 5180. 5180. So we are done with that. Immediately after gross profit, you need to less operating expenses, which is the same thing as operating cost. So I will then come here, operating cost. According to the question, the examiner told you that operating costs include variable costs of 1,500, fixed costs of 2,000, and then depreciation of 254. That means we can't use the operating cost we are given in the question. Yusuf Sanisu, mute yourself. So we can't use the same operating costs we are given in the question. Since examiner has told us that variable costs will increase by 9%, that means we need to increase the 1,500 variable costs given to us. We need to increase it by 9%. Then the fixed cost also, we need to increase it by 6% per annum. All right. Then we're also told that depreciation, all right, depreciation is charged at 10% per annum. on the year-end non-current asset balance before accumulated depreciation, meaning that the depreciation should be charged on the basis of closing non-current assets. So in that case, let's go and do working first. We'll come back to this one later. Let's go and do working for depreciation, additional non-current assets. All right. So let's say this page will be, these 2 pages will be for the main calculation. So let's do our working here. Okay, so we want to calculate closing non-current assets. Closing non-current assets and depreciation. Okay, for the next 3 years. So we are going to use the current value to project for the next 3 years. So we have year 1, year 2, and then year 3. So the current closing balance in the balance sheet. Let's go to the balance sheet. The current closing balance, according to the question, the balance in the balance sheet, the current closing balance is 2532. The closing balance of the non-current assets before accumulated depreciation is 2532. That includes the opening balance plus addition for that period, or plus addition of 132. That's what gave the 2532. So that 2532 is the closing balance, is the current closing balance before accumulated depreciation. So as we are moving to first year, it will now become opening balance. So I will say opening non-current assets. Here is 2532. Then, according to the question, examiner told us that there will be no addition. Let's go back and read that information. There's a place examiner told us that there will be no additional non-current assets. If you have seen it, let me know. Where you are told that the streamlined, no, the level of no, the director will take. I think that's
Said the company will not dispose any of its
yes,
non-current assets,
thank you. I've
but
seen
will
it. The first,
increase.
yeah, thank you. That's the first bullet point. Yeah, you are told that the company will not dispose of any of its non-current assets, but will increase its investment in new non-current asset by 20% per annum. So what that simply means is that, of course, the non-current assets, the composition of the non-current asset will not change because the company is not selling anyone. But you are told that new additions will increase by 20%. So according to the question, we are given new addition to be 132 million naira in the balance sheet. The new addition is 132 million. So we're now told that that 132 million naira will increase by 20% per annum. Therefore, I would then say addition. The current value of the addition is 132. Then we are told it will increase by 20% per annum. Therefore, I will then say 1.2 multiplied by 132 equal, that's 158, 158. Whatever you have in your calculator, multiply by 1.2. That's 190 for the second year. The third year, what you have in your calculator, multiply by 1.2. That's 228. Here is 228. So to now get the closing non-current asset, to get the closing non-current assets, the opening non-current asset plus addition. So this is 2532 plus 158.
2690.
2690. This represents the closing non-current assets. So as you are moving to the second year, the closing non-current asset will become opening non-current assets. So here will be equal to 2690 plus 190. What do you have?
2880.
2880. So moving to the third year, it will become opening non-current asset. 2880 plus 228.
3108.
Point.
3108.
Okay, 3108. All right. So that represents the closing balance. So examiner now told us that depreciation is 10% of the, let me go back to the question so that we can speak the way the examiner has given us. Depreciation is charged at 10% per annum on the year-end non-current asset balance before accumulated depreciation. So it means that depreciation is 10% on the closing non-current assets before accumulated depreciation. So I would then say depreciation, let me write that, at 10%. Okay, so here will be 269, 288, then 311. That represents the accumulated depreciation. All right. That represents the depreciation for each year that we are going to use. So that's that. Then this information will help us when we are calculating free cash flow to equity. Addition, this represents the capital expenditure. Okay, so that will also help us when we are calculating our free cash flow to equity. Then another working we need to do is the operating cost. Remember, we have determined the gross profit for each year. After gross profit, we are supposed to less operating expenses. So to not determine the operating expenses, examiner says that your operating costs include variable cost, fixed cost, and then depreciation. Therefore, we need to go and calculate operating cost. Examiner knows what you are going to face. That's why you are given 14 marks just for free cash flow to equity. So if you're unable to unravel all of this, that means you struggle. You can't earn your full mark. Okay? So this is for year 1, year 2, and then year 3. We want to calculate operating costs. And operating cost is made of 3 items. One is variable cost. The current variable cost is 1,500 in million. Then we are told that variable cost will increase by 9% per annum. All right. So I would then say 1.09 multiplied by 1.5. 1.09 multiplied by 1,500.
1635.
1635 multiplied by 1.09.
1782.
1782 multiplied by 1.05.
05.
Sorry, 1.09.
1943.
1943. 1943. All right. So that's variable cost. Then we include fixed cost. The current fixed cost, according to the question, is 2,000, and this will increase by 6% per annum. So 1.06 multiplied by 2,000, what do you get? Yusuf?
210.
2120.
2120.
20.
Then the next one,
2247.
2247. I'm coming.
2382.
I'm coming. Okay, so 2247.
2382.
2382. 2.
82.
Then we have depreciation. This is working number 1. We have calculated depreciation. This is working number 2. Let me go up there and indicate working number 1. This is working number 1. So, yeah. So depreciation in the first year is 269, 288,
288.
and then 311. So let's add it up.
40. First year, 4024.
4024.
Last year, 4636.
4636.
4317. 4317.
17. So this represents the operating cost for each year that we are going to use. Now that we have the operating cost, we can then go back to complete our free cash flow to equity. You can see this is what the examiner has hidden in the question that you need to go and unravel before we can proceed. So please, you'll be calling the numbers for me. The next one we want to adjust for is operating cost. So the first one is 4024. Let's go and adjust for that.
4317.
I'm coming. Operating costs, working number 2.
4024.
4024. So it's a cash out.
4317.
4317.
Then 4636.
4636. That's it. It's as simple as that. All right. So after operating costs, you remember the free cash flow we are calculating free cash flow to equity. The difference between gross profit and operating costs will give us profit before interest and tax. Therefore, give it to me. What's the hiatus? Give me the hiatus for each year, the difference in each year.
For the last year, 544.
544.
First year, 336.
336. Okay.
435.
435.
435. So this represents profit before interest and tax. Remember, this profit before interest and tax is meant for both equity holders and debt holders. So we have to pay interest. Remember, we have a format for calculating free cash flow to equity. So you pay interest. According to the question, examiner told us that the interest will not change. Let's go back to where we have that information. According to the question, I think it's on the next page.
Point number 5.
Point number 5. Let me pass
The
that.
company
Let me go
pays
back.
interest on its outstanding
Yes,
loan
the
of
company.
1.5.
Yeah. Not even that information, not that information. There's another place where examiner told no additional loan will be. The level of loan, you are told in the question that the level of loan will be maintained at 1.98 billion naira, and interest rates are not expected to change, meaning that there will be no additional interest expense to be paid. So that means it will remain constant. So the current interest, according to the question, is what? Interest
7.5.
payable. No, that's 148. You go to your POL, profit or loss account. The interest expense given to you there is 1.48 million naira. Interest on loan, that's 148 million. All right, so here will be 148. Since it's not going to change, we pay that to the debt holders. 148. 148. Okay. Then after this, we need to pay tax. So you need to determine what's the difference between these two. That will give us profit before tax. Yes.
Year 3,
Yes.
396.
396.
Year 2,
Yep.
287.
287.
Year 1, 188.
188. So that is profit before tax. After this, we need to pay tax. We pay tax at 30%. The tax rate for Vicotoni is 30%. And we are told that tax is payable 1 year in arrears. Let me go to the question where we have that information. The company pays tax on its outstanding loan of 7.5% per annum and incurs tax on profits at 30% payable in the following year. So tax is paid 1 year in arrears. So what that means is that the profit of 188 for the first year will be liable to tax in the second year. However, when you go to the balance sheet, we have tax payable. We have tax payables of 30 million naira. So that the current tax payable of 30 million naira will be paid in the first year. Okay. So here will then be equal to 30. Then 30% of 188 is what?
56.4.
56.4. You round our number, 56.
Okay.
Then 287 multiplied by 0.3.
86.
Pardon?
86.
86. Okay. So that's that. So there's no need for you to calculate profit after tax. So just ignore, continue. So the next thing we need to do is to add back non-cash item like depreciation. And then depreciation in the first year is 269. And then after 269, I think the second one is 288.
288.
Then
311.
311. So this is working number, I think working number 2 or no, working number 1. Then after depreciation, you consider changes in working capital. If working capital increases, you minus. If the working capital reduces, then we add. Okay. So in this case, let's go and determine our working capital. Let's go back to the question. According to the question in the note number two, you are told that investment in net working capital is expected to increase in line with the growth in gross profits. Growth in gross profit is 9%. It means that working capital will increase by 9%. And working capital is not given in the question. So you need to go back to statement of financial position and calculate working capital. So how much is the current working capital? When you go to the balance sheet, the current asset is 900 million. That 900 million naira include cash and bank of 100 million. So when you are calculating working capital, you don't include cash. So you have to remove cash from this 900. That means we have to account for 800 million. Then current liability. According to the question, current liability is 360. Current liability is 360 million. Therefore, 800 minus 360 will give us 440. Let's go and do working for that. That's working number 3. Okay. You want to calculate working capital. Working capital. So as you know, working capital is equal to current assets minus current liability. So according to the question, current assets is equal to 900 million minus 100 million cash. So you don't include, let me put it for you. Don't include cash. in the calculation of working capital. Don't include cash and bank in the calculation of working capital. So that's why we remove that 100. So what that means is that current asset is equal to 800 million. Then current liability, according to the question, is 360 million. Therefore, working capital is equal to 800 minus 360. Let me push it down a little bit.
440.
That's 440. All right. Working capital is equal to 440 million. So this is current value. So this is not what we are looking for. Examiner has told us that our working capital will increase by 9% in line with growth in gross profits. So it will increase by 9% per annum. Therefore, I would then say I need to calculate incremental working capital. Oh, this space will be sufficient. Okay, incremental working capital. Let me go to the next page. I don't want to manage space. All right. Incremental working capital. Year 1 to 3. Years 1, 2, and 3. So the current working capital, according to the question, is 440. We calculate. And we are told that this working capital of 440 will grow by 9% in line with the growth rates on gross profits. Therefore, 1.09 multiplied by 440,
480.
that's 480. 480. What you have in your calculator, multiply by 1.09.
523.
523, multiply by 1.09.
570.
570. All right, you can see our working capital has increased from 440 to 570. So I would then say incremental working capital. What we are looking for is the increment. From between 440, the current working capital is 440. So it has increased from 440 to 480 by a difference of 40.
40.
Then from 480, it has increased to 523, difference of 43. From 523, it has increased to 570, difference of 47, I think. Please come. Okay.
47.
So, yeah, so in the incremental working capital is 40, 43, then 47. Let's go and post. That's our changes in working capital. So 40, it's a cash outflow. 43, then 47. Working number 3. After changes in working capital, you need to consider capital expenditure. We consider capital expenditure. Based on our working, we have additional non-current assets. So, additional non-current assets. That's working number 1. Okay, so go back to our workings where you have depreciation. So addition, 158, 190, then 228. So here is 158. It's a cash outflow. 190 and then 228. All right. Then after non-current after capital expenditure, we go back to the question and check if there's any loan repayments. Examiner told us that there's no loan repayments. All right. And then again, there's no proceed from debt issued. So if that is the case, this is end of our free cash flow to equity. Let's add everything together. What do we have? So this will be the free cash flow to equity. FFE. Free cash
Year one,
flow.
229.
Year one is what?
229.
229. Year two.
Yeah, 346.
346.
286.
286.
286. All right, so that's the free cash flow to equity. 14 marks. You had it to 7 marks in the A requirement. That's 21 marks. You are looking for 79. All right, so let's move on. We're almost there. Yeah. Then requirement number C, you have to estimate the value of Vicotoni on the basis of expected free cash flow to equity and a terminal value based on a sustainable growth rate of 4% per annum thereafter, irrespective of your answer in A, assume required rate of return of 70%. Meaning that examiner knows that your answer, the required rate of return you calculated in A will be 17%. That's why you are given a discount rate of 17% also. But that notwithstanding, we want to calculate the value of Vicotoni, an unquoted company, using a rate of return of 17%. So, of course, when to calculate the value of Vicotoni, we are supposed to use the free cash flow to equity. All right. Therefore, number C, calculating market value of Vicotoni. Our figures is in million. Okay. So year one, year two, and then year three. So to calculate market value, that is, you want to calculate present value. Remember, in my explanation, when you are valuing a business, there will be two stages of your present value. You calculate present value for the initial period. In this question, initial period is the next 3 years. Then you also calculate the present value after the initial period, which is to calculate terminal value. Terminal value is the present value after the initial period to infinity. So to calculate present value to infinity, you go back to the question and check if you are given growth rates or the cash flow will remain constant to perpetuity. In this question, examiner says you should use a growth rate of 4%. I think it's 4%. Let me go back. Sustainable growth rate, yes, 4%. Yeah. So I would then come here, free cash flow to equity. In the first year is 229, 286, then 346. The next thing we need to do is to discount this free cash flow at the appropriate discount rates. So I would then say discount factor. Examiner say we should use 17%. Therefore, give it to me. What's the discount factor for year one at 17%? 1.17 raised to power minus 1. What you get?
0.855.
0.855. Year two?
0.731.
Okay. Year three?
0.624.
624. So let's get the present value. Multiply.
One nine six.
116.
196.
No, 196. 9.
196. Okay.
Two oh nine.
209.
216.
217.
217.
216.
216, okay? So that's that. So we have calculated market value for the initial period for the next 3 years. So we need to add them together. So add up the three present value. So I would then say PV
621.
621. So PV of year 1 to 3 is equal to 621 million. Figures are in million. So we need to calculate present value to infinity, which is terminal value. All right, I would then say PV of year 4 to infinity. All right. Remember, after year 3 is year 4. We have calculated present value for the initial period, which is 3 years, and we got 621 million naira. You need to calculate terminal value to infinity. To calculate terminal value to infinity, the base year is year 3. After year 3 is year 4. Therefore, from year 4 to infinity, we need to get the present value, which should be calculated as free cash flow to equity of the base year multiplied by, before I write down my formula, I need to go and check from the question. If I'm given growth rates or cash flow will remain constant to perpetuity. Examiner told us that there is a sustainable growth rate of 4% after year 3. So this 4% will be for the foreseeable future. Therefore, multiply by 1 plus the growth rate divided by the rate of return. The rate of return we just calculated, which is cost of equity minus the growth rate multiplied by discount factor of the base year. All right. So equal. The free cash flow to equity of the base year is 346. This is the free cash flow of the base year. All right, 346. 346 multiplied by the growth rate is 4%, so 1.04 divided by cost of equity is 17%, 0.17 minus the growth rate of 4% multiplied by discount factor of the base year is 0.624, 0.624. So give it to me. What do you have? So you then say 346 multiplied by 1.04, then divided by 0.13 equal, multiplied by 0.624 equal, give it to me.
1727.
1727. So add the two together. 1727 plus 621. What do you have?
2348.
2348. Let me shift this one a little bit. Let you see. 1727. So here is 2348. That's the value. This represents the total market value, that is present value of Vicotoni. So I will then come here. The market value of Vicotoni is 2,348,2,348,000,000 naira. Let me shorten it. 2,348,000,000 naira. So that's that. Again, this is just 5 marks. Okay, 5 marks. We have earned 26 marks. You can imagine. We have earned 26 marks. We are looking for 74. All right. So that's that. Then the last one, the last part of the question, number D, you have to advise the directors on the assumptions and the uncertainties within your valuation. Okay. What are the uncertainties? What are the assumptions? What assumptions have you made? In fact, wow. No. We've spent, hey, that means we have about, okay, let's see. Well, about an hour plus. Wow. So our time is flying. Let's do this way. Let me just show you Let me open to stop sharing. Let me open Golden Book. Use it to explain that number D. That will save our time. Where are you? 1 minute. Okay. Open. What's the name of the company? Let me share my screen.
Victoria.
Yeah, it's possible I might have changed the name in the Golden Book. Let me just search.
It's Valentico.
Valentico. Valentico. Thank you. You are very
Page
smart.
5555.
Page what?
555.
Okay, 555. Thank you. Okay, that's coming. Yeah, no. Yes, I've seen it. Thank you. Let me remove this. So let's go back to that number D rather. So the assumption, oh, let me just give me my pen. I pause. Just give me 1 minute. Just 1 minute. So number D part of the question, you have to state your assumption and then the uncertainty in your valuation. All right. So the first assumption is on cash flow. What assumption do we make on cash flow? We said that it is assumed that the cash flow estimates are realistic and will occur at the end of each year. However, if the actual sales demand is lower than the estimates, it may reduce the value of the business. In this question, we have been given the sales demand. All right, we have been given sales demand. All those sales demand value we are given, they are just estimates. Actual may be different. So if the actual sales is significant or is relatively is lower than the estimate of 10 billion naira. That means the value of the business will reduce. So that's what I'm trying to say there. Then number two assumption and uncertainty is that we calculated rate of return of 17% using capping. Therefore, the calculation assumed that the required rate of return is consistent with the systematic business and financial risk associated with Valentico. In this case, is a Vicotoni associated with Vicotoni Limited. However, the use of capitalized pricing model may not be appropriate because of the various criticism arising from its assumption. There are 6 key underlying assumptions of capitalized pricing model. One of the assumptions is that market is frictionless. That is, there is no transaction cost. There will be nothing like brokerage fee. There will be no taxation, which is not true. There is no how a business or a company will make profit without paying tax, right? So which make capitalized pricing model assumptions to be unrealistic in practice, okay? Not only that, the assumption of capping also state that investors are price taker. That is, whatever, they don't have any influence, okay? The investors don't have any influence in the determination of price of the company's share. So again, this is not true. This is not realistic, all right? This is because there will be interaction of demand and supply. Both the seller and the buyers, at the end of the day, they will agree at a particular point. But again, that is why to use rate of return as the basis for valuation of Vicotoni is not appropriate because of the fact that capital asset pricing model is is there are so many criticism around his underlying assumption, and that's why it's not appropriate. Then the third one is gearing ratio. All right, the calculation assumed that the debt equity proportion of the proxy company, that is Computer Limited, and that of Vicotoni will not change. That's our assumption. The debt equity proportion will not change. We are given debt equity proportion of the proxy company, which is Computer Limited, to be 40 to 60. The debt equity proportion of Vicotoni is 20 to 80, right? So our assumption now is that if the gearing ratio increases significantly, it may affect ownership structure. That is, the company may be exposed to ownership risk, because if the gearing ratio increases, that way, if the company is unable to pay its debt, then the debt holders may take over the company, or they will dilute the ownership structure. So that's what we are seeing here. These are the uncertainties. All right. Then the next assumption and an uncertainty is on the beta value. We have calculated beta value of 1.68. It is that 1.68 we then use for Vicotoni. So since Vicotoni is not quoted on the stock exchange, it does not have better value. Hence, the better value of Computer Limited, which is the proxy company, has been used to ungear and regear the business and financial risk in determination of the appropriate rate of return. Okay, then the last point that I made is on the business risk. Okay, business risk. Business risk is the risk associated with the industry where a company operates. It's assumed that both Vicotoni and Computer Limited have similar business risk. This appears unrealistic because there is no individual company that is similar in practice. No individual companies is similar in practice, in size, and also in any measure. For example, in our own industry, education industry, providers of accounting training, right? The size of equity professional may be different from any other tuition center, all right? So even though we operate in the same industry, that doesn't mean that we're of equal size, right? Equity professional, we are doing online, we have VI center, we have a solo center, there's another tuition center have only one tuition center, or another tuition center has only online class. So we are not the same in terms of size, but again, it's an assumption, and that's why we are saying that it is assumed that both Vicotoni and then Contagora Limited have similar business rates. So I now said further that this appears unrealistic because every individual company is unique with its own underlying risk exposure, and no company is identically the same in size with another company. So these are the assumptions and the uncertainty in our calculation. All right, examiner did not tell you the number of assumptions you have to make. If you can list like 3, maximum of 5, you are good to go. If you can list 3 or maximum of 5, so you are good to go. And then you hang your 4 marks. Now, before I move to another illustration, we have about 1 hour more. Before I move to another illustration, let me show you the this pen has stopped again. Let me show you the examiner's reports for that particular question. I think this was 2022 May diet. Let me check again. 2022 May diets. Yes. Let me stop sharing. So you can imagine, you can imagine. So this examiner's report, that means that one did not capture it. Anyways, let's move on. Now, we want to talk about, let's have one more illustration on this. Now, we said that using discounted cash flow model, there are three different scenarios that could arise. The first scenario is where business and financial risk will change. All right. When that happens, your free cash flow should be discounted using the work of the combined businesses. Then the second scenario is a situation whereby business risk will not change, but financial risk will change as a result of the business combination. So when that happens, they are supposed to use adjusted present value to value the business. Okay. Then the third one is where business and financial risk will not change. So if business and financial risk will not change, then the valuation should be done by calculating free cash flow. Then you then use the current WACC of the combined business to discount the free cash flow. So that's what you need to do. And we are going to solve three different scenario questions to test the scenario. Scenario 1, we look for a question that we can use. Scenario 2, scenario 3, we do the same thing. Then we are still going to solve addition. That means we have we have 4 or 5 more questions to go. All right. So the question tested last diet, we are going to solve that one too, just to, you never can tell. Examiner may want to serve into your hands. But that notwithstanding, let's have question on the scenario 1. Okay. Let me look for question that relates to scenario number 1. All right. Okay. So let's solve this question. The last time I can test that scenario 1 is 2016. So let me show you how we are going to do it. All right. Yes, I need one of you to read for us. Who is helping us to read? Yeah. Who is helping us?
Eco Products PLC,
Thank you,
EPPLC,
man.
is a producer of a variety of vegetable oil and other household products in Lagos. The company presently faces a significant competition in the market of one of its major raw materials, palm oil. To secure regular flow of the raw material, the directors of EPPLC are now considering making an offer for the entire share capital of Benin Oil PLC, BOPLC, a palm oil producing company in Benin. The following financial information is provided for the two companies: equity beta, asset beta, number of shares in million, and current share price. It is thought that combining the two companies will result in several benefits. It is estimated that combining the two companies will generate free cash flow to the firm of 1,080 million naira in current value terms, but this will increase by an annual growth rate of 5% for the next 4 years before reverting to an annual growth rate of 2.25% in perpetuity. In addition to this, combining the companies will result in cash synergy benefits of 100 million naira per year for the next 4 years. These synergy benefits are not subject to any inflationary increase, and no synergy benefit will occur after the 4th year. The debt to equity ratio of the combined company will be 40:60 in market value terms, and it is expected that the combined company's cost of debt will be 4.55% before tax. The income tax rate is 20%, the current risk-free rate of return is 2%, and the market risk premium is 7%. It can be assumed that the combined company's asset beta is the weighted average of EPPLC's and BOPLC's asset betas weighted by their current market values. EPPLC has offered to acquire BOPLC through a mixed offer of one of its shares for 2 BOPLC shares plus a cash payment, such that a 30% premium is paid for the acquisition. Shareholders of BOPLC feel that a 50% premium will be more acceptable. EPPLC has sufficient cash reserves if the premium is 30%, but not if it is 50%. You are required to A. Estimate the additional equity value created by combining EPPLC and BOPLC based on the free cash flow to firm method. Comment on the results obtained and discuss briefly the assumptions made. B. Estimate the impact of EPPLC's equity holders if premium paid is increased to 50% from 30%. C. Estimate the additional funds required if a premium of 50% is paid instead of 30% and discuss how this premium could be financed.
Thank you very much, Ima. Yes. Requirement number A, you are to estimate the additional equity value created by combining EPPLC and BOPLC based on the free cash flow to the firm method. Comment on the results obtained and discuss briefly the assumptions made. Okay, the assumptions made. Now, you want to calculate additional, examiner asks you to calculate additional equity value created. The additional equity value created will be the difference between the post-acquisition equity value and the pre-acquisition equity value. All right. So before the acquisition of BO PLC, what is the market value? What is the market value of equity? After the combined businesses, after the acquisition, what is the equity value of EPPLC? So what that means is that is of the combined businesses. So the post-acquisition additional equity value is the post-acquisition equity value and the pre-acquisition equity value of the businesses. So that's why you are going 11 marks. So quickly, let's go and solve this. All right, let's solve this. I just hope that we'll be able to finish it. Shouldn't take us, let's see. Solution. So illustration. Then that's illustration number 4 or 5. Let me check. Illustration 5. Illustration 5, page 84. Let me rewrite it. 84. Okay, so the company that is making the initiative is EPPLC, Eco PLC. Then examiner is asking you to calculate additional equity value created. You can't just go ahead and calculate additional equity value. You need to first of all calculate the step 1 is to calculate the post-acquisition equity value. Then step 2, you calculate pre-acquisition equity value. Then you now calculate the additional equity value created. So number A, we have to calculate additional equity value created. Let's do it this way. Step 1 is to calculate let's do pre-acquisition equity value. You are making an offer. Let me even see. It's not a merger, it's an acquisition. So I would then say pre-acquisition equity value. That is, you want to calculate market value of equity before the merger, before the acquisition. Therefore, I will then go back to the question, how do I calculate market value? To get the market value, you need to first of all calculate free cash flow. You calculate free cash flow. So in this case, in the question, examiner has told us that you are told that it is thought that combining the two companies will result in several benefits. It is estimated that combining the two companies will generate free cash flow to the firm of 1,080,000 1 billion and 80 million naira in current value terms. So, but this will increase by an annual growth rate of 5%. So without wasting time, examiner has already given us the free cash flow to the firm to be 1.1 billion naira. And we are told that this will increase annually by 5% for the next 4 years. So I will then come here. Our figures are in million. Okay. So I will do year 1 to 4, year 2, year 3, then year 4. All right. Yeah, Emmanuel, mute. All right, thank you. So I will then come here, free cash flow to the firm. The current free cash flow to the firm is 1,080,000. And we are told that this will grow by 5%. Let me confirm the growth rate. Yes, we growth by an annual growth rate of 5% for the next 4 years. So at 5%, therefore, you then carry your calculator, 1.05 1.05 multiplied by 1080 equal, that's 1134.
1134.
1134 multiplied by 1.05.
1191.
1191 multiplied by 1.04.
1250.
1250 multiplied by 1.04. Oh, sorry, 1.05. 1300. All right. So with this, we have grown the free cash flow to 1313. Okay.
31.
So we 1313, right?
Yes, sir.
So
Yes.
with this, we have grown the free cash flow to the firm. And in addition to this, examiner told us in the question that there's a synergy. Let's go back. In addition to this, combining the company will result in cash synergy benefit of 100 million naira per year for the next 4 years. These synergy benefits are not subject to any inflationary increase, and no synergy benefit will occur after the 4th year. So there's a synergy of 100 million naira. So I would then call me a synergy. 100 million, 100, there is no inflation, no growth. So in that case, you then calculate the net cash flow. This is 1, 2, 3, 4. 1, 2, 9, 1. 1, 3, 5, 0. 1, 4, 1, 3. This represents our net cash flow. You then need to discount this. Now, pay attention. Pay attention. Remember, up to this point, I have not asked you to tell me which scenario are we using. Is this scenario 1? Is this scenario 2? Or scenario 3? So, meaning that because across all the scenarios, you are going to calculate free cash flow. Now that we have calculated our cash flow, the next thing we want to do is to now determine, okay, which cost of capital are we going to use to discount our free cash flow? So in this case, we need to go back to the question and identify the kind of scenario. Remember, I said scenario 1, business and financial risk will change as a result of the business combination. If that is the case, then you are supposed to discount your free cash flow using the work of the combined businesses. Scenario 2 states that business risk will change. Sorry, business risk will not change, but financial risk will change. As a result of that, you use adjusted present value for the purpose of the valuation. Then scenario 3 says that business and financial risk will not change. So if business and financial risk will not change, your free cash flow should be discounted using the current work of the combined businesses. So let's go back to the question. And identify, we are looking for information to determine whether business rate will change or financial risk will change. Remember, when I gave you the notes last week, I mentioned to you that business risk will change if the two combined businesses, they are not in the same industry. If EPPSC and BOPSC are not in the same industry, it means business risk will change. That's one indication. The second indication is that if you are given asset beta in the question for the two companies, if the asset beta of the two companies are different, it means that business risk will change, because asset beta measures only business risk, and business risk measures the industry where a company operates. When you look at the question, when you look at the first paragraph of the question, there is no indication to show that EP and then BO are in the same industry, because, or they are not in the same industry, because you are told that in the first paragraph, you are told that to secure regular flow of raw material, the directors of EPPSC are now considering making an offer for the entire share capital of BO Oil PLC, a palm oil producing. You can see Eco PLC, a producer of variety of vegetable oil. Then the BO produces palm oil. They are still in the same. You can see, somebody can just interpret it that okay, they're in the same industry. That is not clear, because Eco PLC is into vegetable oil. The company now wants to acquire a company that produces palm oil. Palm oil, vegetable oil, it's almost the same thing. They are in the same industry, all right? But this is not clear. Then examiner now give us additional information telling us that, okay, there's an asset beta somewhere. You are given asset beta of 0.9 for EPPLC. You are also given asset beta of BOPLC to be 1.2. So we are given two different asset beta. Since we are given two different asset beta, it means that the two companies, they are not in the same industry. So which means that business risk will change. So I will then go back to the question and identify if financial risk will change. In my explanation last week, I mentioned to you that financial risk will change if the acquisition of the company will result in additional debt or additional loan. In this question, we are not told whether the company will borrow loan for the purpose to finance the transaction. But I also told you another way you can identify if financial risk will change is that if you are given debt equity proportion, if you are told that debt equity proportion will change after the business combination, then it means that financial risk will change. So in this question, in the next paragraph where you after the beta, so you are told that the last statement there, you are told that the debt to equity ratio of the combined company will be 40-60 in market value terms, and it is expected that the combined company's cost of debt will be 4.55% before tax. So examiner has given you gearing ratio of 40-60 after the business combination. So that means the debt equity proportion will change. So in this case, financial risk will change, business risk will change. Therefore, that is scenario one. That means we are going to discount our free cash flow using the work of the combined businesses. So at this point, we need to go and calculate work of the combined businesses. Since we have already calculated free cash flow, so we calculate work of the combined businesses. So let's move on. Let's go and do our working on that. So this would be for, okay, don't let me go too far. Don't let us go too far. Which one? Oh, I was even using, uh, I was using another page. Uh, Let me see if I can copy and paste. Uh, I was using this. This is not, okay, let's say this one. I was using the page we used for the first question that we solved. Let me see. Let me see. I didn't know. Let's go down there. I'll paste whether it will allow me. All right. Let's start from here. Fantastic. So that's okay. All right. So let's move on. So this would be for the value. Then let's do our working here. Let's do our working here without going too far. We want to calculate um work of the combined businesses. Okay, come here, working. Or should I use that? No. We still have about 3 more requirements. So let's leave 2 pages. Let's come down here and do our work in there. Better. All right. So working number 1. We want to calculating work of the combined businesses. Wow, time is just flying. Well, anywhere we stop, we continue next time by the grace of God. Let me help you. Let me put some notes. We can say, according to the question, or as indicated in the question, business risk will change because different asset beta is given for EP, PLC, and BO PLC. Also, financial risk will change because the debt equity ratio after the acquisition will be 40, is it 40 to 60? Let me confirm. Yes, 40 to 60. It'll be 40 to 60. Therefore, work of the combined businesses will be used to discount the net cash flow computed above. Okay, this is shown as follows. The workup is shown as follows. The work of the combined businesses is calculated as follows. Remember what I told you last week? Work of the combined business is calculated the same way as WACOCA. So the only difference is just that you are calculating for businesses instead of activity. So step 1, to calculate WACOCA, we said there are 7 steps. Step 1 is to identify the beta of each activity. In this case, it's not activity. It will be beta of each company. Step 2, you ungear the beta. Step 3, you calculate market value of equity and debt of each company. Then step 4, you calculate the asset beta of the combined or weighted average asset beta. Step 5, you regear. Step 6, you calculate cost of equity. Then step 7, you calculate weighted average cost of capital of the combined businesses. So step 1, so I will say beta of EP and PO. So EP has asset beta. So we are given asset beta. So in this question, we are given both asset beta and also equity beta. What we are looking for is asset beta, not equity beta. So for EP has asset beta of 0.9. Then BO has asset beta of 1.2. So because they are asset beta, that means asset beta is an ungeared beta. There is no need for you to ungear again because this is an asset beta. So that means we are going to ignore step 2. Step 2 says you should ungear. That is, you calculate asset beta. Since you have been given asset beta already, so you don't need to ungear again. So step 3 now, which should now be step 2, is to calculate market value of equity and debt for each company. All right, so market value of equity. This will represent the pre-acquisition market value. Okay, I want to calculate pre-acquisition market value. That is market value before the acquisition. Pre-acquisition market value of EP and BO. That's the next thing we want to do. We have skipped one step, which is to calculate asset beta. Because we are given asset beta, that's why we did not calculate asset beta again. All right. So I would then say, how do I calculate market value of equity and debt? I will go back to the question. I want to calculate market value of equity. To get the market value of equity, I'm going to multiply number of shares with the current share price. So we are given current share price for each company. We're also given number of shares for each company. So market value of equity. Simply say equity value. Anyway, market value of equity denoted as E, okay, which is calculated as number of shares multiplied by share price. So for EP, number of shares, what's the number of shares of EP? That's 210 million shares. Then share price is 29 naira. So 210 million shares multiplied by 29 naira. Then for BO, number of shares of BO is 200 million. Share price is 12 naira. 200 million shares multiplied by 12 naira. So 210 multiplied by 29, 210 multiplied by 29.
6,090.
6,090. 6,090. That's the market value of equity of BO, sort of EP. Then this one will be 2,400.
400.
All right. So let's go back. If you are given debts for each company, I doubt it. When Emmanuel was reading it, there was nothing like debts. All right, before the acquisition. So we are not given debt value. There's no debt value, no bond, no bank loan, no debenture, anything to calculate the market value. So you're not given. That means before the merger, the companies only have the equity value. So in this case, the pre-acquisition equity value of the combined businesses, the pre-acquisition equity value of the two businesses is 8,490. So this is the pre-acquisition equity value. Okay, so 8,490. So I will then go back there. Step three. Step three says we should calculate asset beta of the combined. Asset beta of the combined. Step three. So calculate asset beta or weighted average asset beta. Let's call it weighted average asset or asset beta of the combined, whichever one. Let me put it properly. Combined assets beta. That is BAC. Okay. So to get the combined asset beta, beta asset of the combined is calculated as beta assets of EP multiplied by total market value of EP over total market value of EP and BO plus beta assets of BO multiplied by total market value of BO over total market value of EP and BO. All right, so let's move on to the next page. So the beta asset of the combined is what we are looking for. Equal beta asset of EP is 0.9 multiplied by market value of EP is 6090 over the total market value 8490 plus beta asset of BO 1.2 multiplied by market value of BO 24 over total market value 8490. Give me from the left. What do you have there? 6090 divided by 8490 multiplied by 0.9. What you get?
0.65.
Pardon?
0.6.
0.65. Okay, plus the right side. 2400 divided by 8490 multiplied by 1.2. 0. What?
0.34.
0.34. When you add it up, what do you get? That's 0.99. So the beta asset of the combined is 0.99. Then step 4 says you should regear. You regear to incorporate financial risk. Now, when you are regearing, you are going to use information after the business combination. Okay, to regear, in the question, we are not given debt beta. Therefore, to regear, I would then say beta equity of a gear equal to beta asset of the combined, right? Then multiply by 1 plus 1 minus tax, debt equity proportion of the combined businesses. Therefore, beta equity of a gear equal to 0.99. That's our combined asset beta. Come, that reminds me. I'm not sure if Charity is in this class because I trust Charity. If she's in a class, you would have you would have called me and asked a question. She's not in this class. Charity, where did you go? All right, let's move on. So 1 plus, then what's the tax rate given to us in the question? What's the tax rate? 20%, 20. Okay, yeah, income tax rate is 20%. Okay, that means we are supposed to account for 80%. Then debt equity proportion after the business combination is what? According examiner told us that the debt to equity ratio of the combined company will be 40 to 60 in market value. Okay, so debt equity ratio is 40 to 60 after the business combination. So here will be 40, here will be 60. Therefore, the beta equity of a gear will then be equal to 40 over 60, 40 divided by 60 equal, then multiply by 0.8 equal, multiply by, plus 1 equal, then multiply by 0.99. That's 1.52. 1.52. Then steps 5 is to calculate cost of equity. Calculate cost of equity using capping. Okay, using capping. So in this case, cost of equity will then be equal to risk-free rate of return plus beta into market return minus risk-free rate of return. What is the risk-free rate of return in the question? What's the risk-free rate of return?
Percent.
Pardon?
2%.
2% plus beta of 1.52. Are we given market return or risk premium?
Risk premium.
How much is
7%.
risk? 7% is the risk premium. So final answer, 7 multiplied by 1.52, 1.52, sorry, this is 1.52 equal, then plus 2 equal, that's 12.64. Okay, here is 12.64. Cost of equity is 12.64. Then step 6, we then calculate WACOB. Calculate WACOB, WACC of the combined businesses.
There's a question, sir.
Talk to me.
The risk premium minus the risk-free rate is not supposed to be 5% instead of the 7%, because the 7% is representing only the market risk premium. The risk-free rate was not deducted. Well, I'm not saying well.
You can't deduct risk-free. You have been given risk premium now. The difference between RM and RF is risk premium, which is 7. So you cannot deduct risk-free again.
Thank you, sir.
You're welcome. So WACC will be calculated as equity value over equity plus debt multiplied by cost of equity plus debt value over equity plus debt multiplied by cost of debt, 1 minus tax. All right. So in this case, our equity value, we are told that debt equity proportion is 40 to 60. So equity is 60 over 100. That is 40 plus 60. Then multiply by cost of equity, we got 12.64%. Keep it on the left, plus the debt value is 40%, so 40 over 100 multiplied by cost of debt. According to the question, you are told that cost of debt will be 4.55% before tax. So KD is 4.55. So multiply by 4.55%. So before tax, then you multiply 1 minus tax. So we account for, I think tax rate is 20%, right?
Yes, sir.
So we are supposed to account for 80%. So from the right, so we need 60% of 12.64 multiplied by 0.6. That's 7.58. KW equal to 7.58% plus from the right, which is 0.4 multiplied by 4.55, then multiply by 0.8. That's 1.46, 1.46%. So we add the two together. 7.58 plus
9.04.
9.04%. 9.04%. So approximately our work, the work up is equal to 9%. You can see we could not proceed with our market value calculation because of cost of capital that we need. So at this point, we need to go back there. Let's go, let's continue. Now that we have our work, then we can then say 9%. So give it to me. Discount factor for year one at 9%. What do you have?
0.9, 0.917.
917. Year two,
842.
0.842. Year three,
0.772.
772. Year four,
0.708.
708. That's it. Let's multiply to get the market value. This is working number 1. Okay. So present value. Valuation is not difficult if you understand the techniques. Just know what you are doing. So give it to me. What's the present value for each year? Let me do for year 4. Say 1
1132 for the first year.
1132. Okay.
Second year, 1087.
Okay.
Third year, 1042.
And then the fourth year.
1000 fourth year.
1000.
1000. So add it up. This will give a present value of year 1 to 4.
4261.
4261. So, all right. So the total market value for the next 4 years is 4261. So we need to calculate terminal value to infinity. So I would then say present value after year 4 is year 5. Therefore, present value from year 5 to infinity will be calculated as free cash flow. Now, examiner has told us in the question that the synergy of 100 million naira, there will be no synergy after year 4. So that means we cannot use, let me scroll up a little bit. So we cannot use 1413 as our base year cash flow because examiner has told us in the question that this synergy of 100 million naira will not happen again after year 4. So what that means is that we are going to use 1313 as our free cash flow of the base year. So free cash flow of the base year multiplied by, then what's the growth rate after year 4? you are told that, yes, before reverting to an annual growth rate of 2.25 in perpetuity. So growth rate is 2.25. I would then say multiply by 1 plus G all over the WACC minus the growth rate multiplied by discount factor of the base year. Okay. Let me see whether I still have space there. Okay, let's manage here. So PV here 5 to infinity will then be equal to 1313. The growth rate is 2.25. Therefore, 1.0 is it 2? Let me check again. 2.2, yeah, 2.25. 225. All right. Then divided by our WACC. WACC is 9%, 0.09 minus growth rate of 2.25, 0.0225 multiplied by discount factor of the base year. Discount factor of year 4 is 0.708. So give it to me. What do you have there? What do you have? 0.09 minus 0.0225.
14080.
14080, right?
82.
Is it 82? Okay.
Yes.
082. So let's add it up. Add it to 8261. Sorry, 4261.
18342. 343.
8343. Okay, so that represents the total market value. This is the total present value. That is market value. So the corporate value, remember, examiner asked us to calculate market value, additional equity value created. And we said that additional equity value created represents the difference between the post-acquisition equity value and the pre-acquisition equity value. So in this question, we have not, let's calculate the post-acquisition equity value. Let me check whether I've written that down before. Okay, no, I've not. Okay. So I would then say the corporate value, this total market value of 18,343 represents the corporate value. So we need to deduct the debt value. So I would then say corporate value or equity value. Let's do equity value. Equity value. All right. Let me help you put down something. Equity value represents the difference between the enterprise value. Corporate value is the same thing as enterprise value. Okay, let me just use corporate value. Difference between corporate value, that is total present value, and the debt value, Okay, as shown below. All right. So all we need to do to get equity value is, in fact, it's not just equity value, it's the post-acquisition equity value. Let me put it there. Post acquisition equity value. All right. So I would then say equity value, which is the corporate value of 18,343 figures in million, less the debt value. Corporate value less debt value will give us equity value. So, and we are told that the debt equity ratio is 40/60. So debt is 40%. So 18,343 multiplied by 40%. What do you get? What do you have?
7337.
7,337, right? So minus 18,343. That's
11006.
11,006. So this represents the equity value. This is how to calculate the post-acquisition equity. If I don't want to do it this way, since I know that corporate value is 18,343, I will just multiply 60% on that. That will give me equity value. So now that we have the post-acquisition equity value, then we need to determine additional equity value created. So I will then come here, additional equity value created. So like I explained to you earlier, the additional equity value created represents the difference between the post-acquisition equity value and the pre-acquisition equity value of the businesses. So this represents the post acquisition. Maybe when we are done with this number A requirements, we stop the class. Then we continue next time by the grace of God. This represents the post acquisition equity value and pre-acquisition equity value of the combined companies or of BO, of EP and BO. All right. This is shown as follows. Okay, so we want to get additional equity value. So I would then say additional equity value. Figures in million. All right. So the post-acquisition equity value is 11. Post-acquisition equity value is 11,006. Then the pre-acquisition equity value of the two businesses, we calculated 8,490. Let me go there and confirm that number. Let's see, what do we get? Is it not 8,490? Yes. The pre-acquisition equity value is 8490. So, what's the difference? What's the difference?
2516. 2516.
2516. That's additional equity value created. So we then say the additional equity value created is 2,516,000,000 naira. Okay, 2,516,000,000,000. Okay, so that's that. That answers number A. I think that's 11 marks. All right. Within the next 15 minutes, we'll finish it, but I don't want to overstress you. So we'll continue. In our next class, we are going to do B and C. All right. So let me know if you have any question for me, or can you spare the 10 minutes or 15 so that we finish the question once and for all? If not, we do it now. Some of you have even disappeared. No worries.
Yes.
Should we complete the question or we'll do it next weekend? Sorry, next week.
Next class, sir.
All right then. Okay, no worries. Thank you, everyone. Let me know if you have any question before we close the class.
Sir, please, I want to ask, sir. Are you
Yes,
going
then.
to take us decision tree?
Pardon?
Are you going to take us decision tree under risk and uncertainty?
I said this now, we were doing risk and uncertainty before the Independence, was it Independence Day? Yeah, before that. So I was supposed to take decision tree, which is the last scope under risk and uncertainty, but because it was a combined class, so I couldn't do that. We did business valuation, and I now said after valuation that we are going to do the decision tree. I even said it last week too.
All
All
right.
right.
All right, sir.
So we are going to do it by the grace of God.
All right, sir.
It even came out last direct. Decision tree came out last direct. All right. So in the absence of no further question, I want to say thank you to every one of you for your patience. I will see you next week by the grace of God. Good night, everyone.
Good night, sir.
Yeah, good night. Good night.
Good night, sir.
Yeah, good night.
Good night, sir.
Wumi, take care.